And now I'm very pleased to invite Robert Christen to deliver a keynote address on the whole evolution of microfinance over the last 3 decades. Robert is the president of the Boulder Institute of Microfinance, as well as professor of practice, public administration, and international affairs at the Maxwell School of Citizenship and Public Affairs at Syracuse University. And we are thrilled that he is able to join us today to set the context for our workshop. Thank you.
Good morning, everybody. It's great to be here. It's great to catch up with some, I sometimes say old friends that they don't like it, but friends who have been friends for a while. And it's great to see some people who are perhaps new or interested in the topic to begin with. So I've been given the task of talking about what has now become sort of a $25 billion sector in 30 minutes, and that's cool. You know, I love being here at the launch of the book. The first version was fabulous. We gave out a lot of copies at the Boulder Institute programs, and we'll give out thousands more of the new book. It's a great book, and I couldn't be more pleased to see it come to fruition. So I'm going to do a real run through, and I'm going to start with one of the more controversial topics, right, of microfinance. Today we're getting a little bit of angst around whether microfinance is having the impact that many thought it should have, and I'd like to settle that matter in 2 minutes. I think formal finance matters. It's pretty clear from studies and macroeconomic analyses that the building of financial sectors matters to economic progress. I think that's a fairly settled matter. I don't think there's a lot of academic debate about that anymore. In our own countries, in the global north, what were the first messages coming out of Ottawa and Washington after the financial crisis? Please, people, spend. We've got to spend our way out of the crisis, right? It's pretty clear that the contraction of credit takes away a fundamental economic driver, right? And go no further than spend a couple minutes thinking about what your lives would be and the lives of your families without health insurance, a pension, a savings account, a credit card, a housing loan, a car loan, et cetera, et cetera, et cetera. Could you accomplish the things that are most important to you if you didn't have those fundamental basic financial services that we at this point take for granted? So subtract them from your lives and even try and imagine how you would accomplish things that are most important to you. So I think it goes without saying that formal finance matters. There is a conversation about how much building formal financial services ought to be subsidized, and that's a perfectly valid conversation. But whether or not financial services are good for people is something that should be a pretty settled matter. The problem that many of us have spent some decades working on is the problem of providing access to poor people, people living on a couple dollars a day or less. The problem has been the same all along. The problem is it's really expensive to have those small transactions as a percentage of the value of the amount of money that's moving, whether it's a savings account or a loan, right? It is a problem that has never gone away, okay? If you think about it in those terms, it's really clear to see why the financial sector, the formal financial sector, has had a hard time figuring out whether this class of individuals or of society is worth bothering with. Why? Those are transactions I can't make any money on, I can't deal with effectively in my organization, so therefore I don't even think much about it. Since I don't think much about it, I'm prey to all sorts of prejudices and ideas about what that sector looks like in terms of risk, in terms of profitability, in terms of moral character, all the sorts of conversations you hear in the banking community writ large about serving lower ends. The math is simple. When I first got into this and looked at conversations in the late 70s, I remember a famous paper by Nimal Sandaratne from the Central Bank of Ceylon at that time that was pointing out that for a small farmer to go get an ag loan, the cost of all the going to the office and the paperwork was 75% of the value of the loan. That's where we started 30 years ago. 75% of the value of the loan that was going to be got at the end was used up in going to get it. That's a lot. Okay? That fundamental reality has driven all of microfinance thinking since, right? Because bankers didn't think much about the poor, when the first generation of development finance projects, mostly in the agricultural sector, failed miserably because they were so poorly designed, you ended up just reaffirming the prejudice that the banking community has against the poor. They're viewed as risky, poor character, etc. Now, this sounds like old talk. Well, that's what it was back in the day, and it still is in so many countries to this day, right? We've developed a whole microfinance community that doesn't believe that anymore, but there's still some distance between what a lot of us have dedicated our lives to and what a traditional commercial banking sector might think in a lot of different countries in spite of our progress. We've made some progress. Undoubtedly, the poor have variability in their income flows, which needs to be accounted for. Undoubtedly, they have risky lives, in some ways much riskier than our lives because of the variability of income opportunities and because of things that happen to them that affect them more than us because they don't have the buffers and the safety nets to fall back on. I want to kind of go through big periods of time in the evolution of financial services for the poor. I kind of have named 3 times, version 1.0, version 2.0, and version 3.0, just for fun. We're in a modern software-driven world, right? So I kind of looked at version 1.0 as a version I came into. It was largely concluding when I got in the late 70s and early 80s. Back then, it was the heyday of the integrated rural development projects. You've probably read about those dinosaurs, right? And actually, we have some now called integrated rural and conservation projects that are seeming to repeat many of the same errors, but we won't go into that. In that scheme of things, of course, the poor were considered to be not very good at anything. And so we needed to help them with business plans, marketing studies. We needed to help them sell their products. We needed to train them. We needed to advise them. We needed to give them loans. We needed to do all sorts of things to help them progress. I'd say from sort of 65 to 85, we went through a whole process of engagement with clients where all the non-financial services fell away one by one because it just became clear over time that what the families really were focusing on was most helpful was the credit. So we ended up with what we call a credit-driven model by about 85. We ended up by then with all the basic lending techniques having been developed, whether it was solidarity groups or village banking or whether it was individual loans. All these things had kind of come to being by about 1985. I have a personal opinion I'm going to share with you because all the rest of what I'm saying is absolutely fact-based. The personal opinion is, I actually think when you look back at this 30 or 40 years from now, Dr. Eunice and the Green Bank will be remembered, and maybe not so much even for microcredit. I think the seminal contribution is that the Green Bank experiment and this microcredit thing that's been going on is one of the first, if not the single most important bet on poor people. That poor people are the actors of their own progress out of poverty. That believing in them and believing in their financial progress is fundamental to progress of nations. I think that may be the seminal contribution, not some microcredit technique, but rather the fact, wow, poor people are valid economic actors. Let's engage them and support them in their pathway out of poverty. That thinking was not prevalent before microcredit. I think that's what we'll be remembered for long. Personal opinion, welcome to reject it as you wish. Version 2.0. By about 85, when I came into this, it cost about $3 to lend $1. because we did all this other stuff, right? You had to help them so many different ways. By about 85, it was costing us 50 cents to lend $1, 40 cents to lend $1. But it also became very clear because of the concentration of early microcredit into buy-sell activities, buying, selling, little productive activities, where the marginal return on additional liquidity was so high, right? Is that okay? Right? They made so much money with extra little bits of capital that you could imagine charging interest rates that were high enough to recover the cost of lending if it was costing you 40 cents on $1 to lend $1. Sounds high, right? Everybody's going, whoa, we're not too comfortable with that. Yeah, but remember, those buy-sell activities frequently are financing themselves in a marketplace at 5 to 6. You borrow 5 in the morning, pay 6 in the afternoon. So sure, 40% a year is a gift. Okay, so that's the reality of about 1985. That's when we start understanding that maybe there's sustainability is possible, and as a result of sustainability, outreach is possible. If you can cover the costs of providing the services, then you ought to be able to provide lots of services with a specific subsidy. That's the change in thinking. And so the next 20 years are I call them institution building years. We build a whole class of organizations specially devoted to the proposition of microfinance. It's really kind of mostly microcredit, but they're special organizations that have a double bottom line in most cases and a mission to provide credit on as big a scale as possible. What we end up with is, in so many countries where there's not too much donor money, you end up with a more commercialized model from almost the very beginning in 1985, where organizations in places like Chile or Paraguay or the Philippines, other countries where you don't have quite as much philanthropic capital available, already engaging in the banking sector to borrow money to on-lend, right? Because there isn't enough free money to make a difference in that country. So you develop a whole more commercialized, institutionalized approach over these 20 years, and all the apparatus that goes into credit ratings, into understanding whether financial performance is good enough to be subject to credit in financial markets. And at this point, I think, Steve, what is it? Do we have a $25 billion investment by social investment funds? You know, that's pretty significant if you look at a 20-year history in the development of a sector. From almost zero, in fact, I personally made, I think, the first loan under the Acción Guarantee Fund in Costa Rica, to a $25 billion field fundamentally financed by social investment funds. That's massive, right? You have all the apparatus that goes along with validating financial performance. Today, there have been a number of studies that show that something like 85% of clients in any one country are attended to by the top 5 organizations in that country. And that seems to be true globally. When you look at those organizations, they're typically profitable, sustainable enterprises that have reinvested profits into their own growth. Remember, basic banking is a little bit of capital, a lot of leverage, outreach, right? That's the banking model. And that's what microfinance has been able to get to, right? It's been able to leverage small amounts of capital through the social investment, through borrowing, sometimes through savings, to make a lot of loans. Those organizations that have believed in that creed strongest are the ones that have grown and at this point have by and far the largest number of clients. Version 3.0, client-centered. I believe this conference has got clients at the center, right? It's part of its leitmotif, right? This is part of what we're talking about here. Clients at the center. What does this mean? Well, a number of you have probably read books, other books. Can I talk about another book at the launch of this book? Just one other book, okay. So, you know, there have been some great books coming out about clients, the poor and their money many years ago, Portfolios of the Poor, the Financial Diaries work. There's a lot of work over the past few years that is really getting deep inside the financial lives of the poor, right? And trying to understand what's the broad range of financial services that would be helpful in their lives. What do they do informally, and how can we be helpful formally? How can we add value to those financial lives? How can we help them achieve those family goals that are so fundamental, right? So it's been great. We're a bunch of economists sitting around doing finance, but these fundamental insights have come from anthropologists, right? People really get out there and get families' financial lives. And what I believe is going to be the development of the next 20 years is really client-centered. And by that, the conversation needs to move towards what's really helpful for poor people. Let me give you an illustration of something of that sort. Opportunity International Bank in Malawi offered, I'm going to call it a harvest savings account. When tobacco farmers come in to sell their tobacco, there's somebody from the bank waiting and says, hold it, here's an opportunity. Instead of taking the cash and going home and doing whatever you would do with it, why don't you take what you need and put it in a savings account where we're going to lock it up for 4 months until you need it again to plant. Buy fertilizer, buy seed, okay? So you voluntarily, you say, yeah, here, take it. Keep it locked away so I can't do anything with it. Well, the result of offering this sort of account is that the farmers who had locked away their money had it available. The use of fertilizer went up, yields went up, incomes went up substantially through doing no more than offering an opportunity to keep money safe and hidden for 4 months. It had the same kind, if not even more impact than a loan might have had, and at far less cost to the client. This is what we mean by thinking about clients' lives, how to be really helpful in the flows and the goals that they're setting out for themselves, the cash flows in that household, how to figure out products that are tailored to what's important to them. That's, I think, where we're going to go for the next 20 years. We've built the institutions. It takes big institutions, national institutions, to really do this work with clients. Because the kinds of things that are really helpful are complex, oftentimes need significant investment in information systems and in technology, in point-of-service devices to get products close to people. In fact, we're in a brave new world of institutions. Version 1.0, we had basically institutions that did all sorts of things and a little bit of finance. Version 2.0, we had specialized kind of microcredit institutions. We called them microfinance institutions. Most of them were microcredit, although a growing number were doing savings. Version 3.0, in order to offer insurance and deposits and money transfers and credit, you're going to end up with a financial ecosystem where there's all sorts of partnerships, and each class of institution is playing its own very specific role. And they're going to have little pieces along the financial service delivery value chain. It'll be a brave new world for microfinance institutions. Areas of opportunity, market segments. Seems when you think about clients, there's some really big areas to explore. One is unserved or underserved market segments. Microcredit was always synonymous with microenterprise, correct? But there's a ton of people out there, small farmers, day laborers, very low-end salaried employees, for whom our product design doesn't work all that well. So there are big market segments of people living under $2 a day that we have yet to reach with your classic microcredit product. There's a lot of work to do there. There's also a lot of reason to develop non-credit products for those people. A domestic worker might prefer to save for a wedding than get a loan. How do we do that? Do we help that happen? When you think about it, are all poor equally worthy of our thinking about our usefulness to their sort of financial lives? You could think so. When we got into this, we said the productive poor are more worthy, right? They're more worthy because they're engines of economic progress. Well, if you take a step back and say, what we're really about is helping the poor achieve their family goals, educate their kids, get health care, roof over their head, all of a sudden, kind of all poor are equal, right? I mean, there's not a narrative that says we should prefer these poor. When you think that all poor are equal, all of a sudden it becomes very clear that savings and insurance and money transfers are just as valuable, if not even more valuable, for other kinds of poor than we have typically thought about when we take a microcredit or a microenterprise approach. Some countries have a lot of microcredit, microfinance, savings. And then life cycle events, when you go back to that case of the farmer, right? It's not so much a life cycle, but it's a productive cycle. Well, just like that, you have children to educate, you have illnesses that happen, you stop being productive at some point in your life. There are big events that happen in life around which a lot of families organize their finances. We don't do much yet to be really helpful that way. How am I doing on time? I got time, right? Lots of times. I went too fast. So you want me to like stretch it now, or? Okay, that'd be good. All right. I'm going to do a couple of closing thoughts here. All right, again, opinion, not fact-based, opinion. So Joyce, you might remember this, Remember Jake came back one day when we were at the Gates Foundation, and he had been over in Kenya looking at M-Pesa. Hands up, people who know about M-Pesa, this mobile money thing in Kenya? Okay, this is sending money to mom back in the village when you work in Nairobi and have a job, right? Mom says, I need money. Faithful son and daughter in Nairobi sends money home. That's what this is, right? And it's a system that allows you to put cash in Nairobi and take cash out. Mom gets to take cash out, okay? So anyway, this is available in like 20,000 places wherever they sell airtime. Do people know that overseas, most phones aren't on plans, right? They're prepaid. You got to buy time all the time to talk, right? So there's thousands, tens of thousands of places, okay, that you buy time. Well, in Kenya, for those who didn't know as much, a lot of these places now do this cash-in business where you can take cash in and put cash out of the system. So that's the background. So our program officer, Jake, was sitting outside one of these shops, and he just starts talking to people. So Nelson comes by. Nelson's like this kid, 19-year-old kid. So what are you doing, Nelson? Well, I'm dropping off some money. Oh, really? So what do you do? Well, I sell little things on the bus, okay? Like, razors or candy. He says he sells about $3 worth of stuff on the bus every single day, okay? Now, so what do you do? Well, I'm dropping off $1. He wasn't, right? He was dropping off Kenyan shillings, but just, 50 Kenyan shillings, about $1. Okay, so why? Well, I come in every day and drop off about $1 because I want to be a mechanic. And I found this school that I can go to that costs $232. So if I come in here every day and drop off a third of what he sells, he is planning on going to mechanic school, and then he doesn't have to sell anything on the buses anymore because that's not as good a life, right? He would rather be a mechanic, okay? So what do you think the chances are that if Nelson took that $1 home every day and put it under his mattress, he'd ever go to school? 0? More than 0? Not much more than 0. But Nelson's not going to save for 232 days money safely at home. $1 a day. How much do you think it costs a bank when you stand at a teller window? When you go and do a cash transaction, how much do you think it costs a bank? Anybody know? Any bankers here? It's sort of true globally. It's kind of a number, $1. That's what it costs them to have you stand at a bank window, okay? So Nelson's dropping off $1. How happy is the bank going to be to see Nelson? Not very, right? So really fundamental question we have before us as a community of people who care about the Nelsons of the world, who by his own effort is pulling himself up, right? I mean, this is not a guy looking for a handout. He just wants to keep his money safe, right? How can we help Nelson? Where are the systems that we can develop that helps that happen, because he'll get it done if we can help him. That's a closing thought. The cheapest we've been able to get a transactional interface going for is kind of about 35 cents on a dollar that involves cash. How much would Nelson pay to have his money safe? We've got some data that says Nelson might be willing to pay about 10%. People in susu collectors in Ghana, people in Bangladesh, people in other places pay about 10% to keep their money safe. Pay. They're not getting interest. Pay about 10%. But still, you know, from 35 cents on a dollar to 10 cents on a dollar, there's still some distance to go. So one of my closing thoughts is, wow, sometimes I feel like the conversation seems like we're sort of done with microfinance, got it figured out. I'm kind of going, whoa. There are 10 Nelsons for everybody who wants a microloan. Every time you do savings right, you get about 10 accounts of people who want to save their money to everybody who wants a loan. Those are the facts. That's a fact. That's not an opinion. Okay? Wow. We got a whole lot of work to do to help Nelson. Now, Nelson may be on an extreme, only saving $1. But hey, maybe not two either, huh? Okay. Second, and then I'll shut up, and if people want to ask questions or challenge my opinions, feel free. Debate for the soul of microfinance. A little bit of conversation, angst about whether we are having the effect or the impact we need to have, whether profits are good or bad. Should microfinance be the moral equivalent of the Sisters of Mercy Hospital in a small village, where philanthropy makes sure that services are available, but they run on a bit of a sustainable, ongoing basis? Or should it be an outright commercial enterprise? Which is the right space for us to operate in? There's a ton of concern about this, right? I think that's a profound concern, because if you actually look at microfinance in the construct of being a nascent industry that is making largish early profits and reinvesting in the growth of this activity, you could make a case that in many, many, many countries, the existence of strong profit is what has driven growth. If you believe that outreach is a valid impact goal, the connection's pretty clear. Yet we have an awful lot of angst about how much interest is too much, how much profit is too much, and we have a lot of angst about whether financial system can regulate itself very well. And there are a number of countries where you would have expected to see interest rates coming down where they're not. And there are countries where they certainly are, where competition seems to be having the effect that you'd like to have. To me, this is a fundamental conversation we need to have, because I do worry about premature capping of profits and interest rates, eliminating the possibility for growth, really reducing in so many places in the world that don't have an excess of free money, the ability of organizations to reinvest in what I hope is version 3.0 of microfinance, which is let's come back around to the Nelsons, to the small farmers in Malawi, and figure out how to be really, really useful beyond the sort of very simple microcredit that we've developed to this point. Those are my kind of provocative closing thoughts. Thank you very much.
I understand that you mentioned that there is a need for big institutions. Are these institutions for managing the funds, for providing the technical or logistical support? What for?
Okay.
Thank you.
So when I make the argument that in the future of financial services, you're going to need large institutions, a lot of the technologies you'll hear about later on today, or a lot of the kinds of products, and also our ability to affect the transaction cost problem, right? Get the services close to people requires investing in models called agent banking or some other kind of point of service device that gets you physically closer to the clients. Those kinds of systems typically need to be developed by players who act on a national scale, or certainly on a regional scale in a big country. Just because the investment is often tens of millions of dollars to get those kinds of networks, payment systems, to solve the transaction cost problem, mostly for clients. So let me make it real simple. On average, it costs $1 for you to stand at a teller window of a bank. We seem to have gotten it down to about 35 cents, 45 cents on a dollar to go to an ATM or a terminal, a swipe card terminal in your village. Okay, so that's taking out 65% of the cost. But for the client, not having to get on a bus, drive an hour or 4 hours to the bank, stand in line, not be treated very well, and go all the way back home, the savings are 90%, 95%. So for us to really make an impact on clients' access to financial services, you have to move the points of service closer. That's, I think, so far requiring pretty big investment. That's why I make that argument.
Deki Kipuka. I agree with your analysis, which is most focused on the micro level of microfinance beneficiaries. But I'm just wondering, where do you put the banking or financial regulation in your analysis?
Well, the regulation side is pretty fundamental. I think you'll hear a lot from Steve and Kate and others later, because if you take a financial inclusion perspective, and if you remember that maybe 10 people want a deposit account for everybody who wants a loan, then you're right in the sweet spot of banking regulators, right? Because you're talking about capturing deposits from the general public. And so therefore, regulation and supervision moves to the center of a financial inclusion agenda like it never was with microcredit, right? As long as microcredit was dominated by nonprofits or specially licensed non-bank financial intermediaries, the central banks could take a bit of a standoff view, right? And say, as long as we're not mobilizing deposits from the general public, we don't have to get so involved. We just need to make sure that these entities are safe and sound for basically on lending, usually government funds, right? So the level of test wasn't so high. But certainly in a broader financial inclusion, it's impossible to even imagine providing a full range of financial services without getting regulators right into the heart of that conversation. I think that's where CGAP has done, a marvelous job these past few years in working with standard-setting bodies and really having that conversation at a level that, as it was a microcredit movement, was never necessary. So that's a great improvement.
Yes, hello, I'm Catherine Hewlett-Jobez. I worked at the Multilateral Investment Fund for some years, and one of the core issues that we were struggling with at the time was how to get robust social performance indicators. Because if you're thinking about the regulatory framework and asking for special consideration for microfinance institutions, there needs to be a way to capture in a universal way. So if you could comment on latest developments in that.
So I'm probably not the best person in the world to comment on the latest developments in that area. I think it's an area that people have struggled with for a number of years to figure out what those social performance indicators really should be. How are they tools to manage with? Are they impact evaluation devices? So I think there's been a very rich conversation about that. My sense is that this is of primary interest, even more than for regulators, to the investing community, right, who's trying to figure out whether the social investment funds are going to the right kinds of organizations that are truly committed to the bottom end, right? There's always this concern about financial institutions drifting up in the market, and I think that's been the impetus for that. But I can't tell you about the latest conversation on social performance.
Okay. Hi, I'm Kate Lauer. So much of what you are talking about has to do with limited availability of capital. So if you can make more money serving a wealthy person than Nelson, then you'll do that. And if there weren't limited capital, then we wouldn't have such a problem. And I'm wondering, do you see the problem getting more difficult because of the increasing divide between the wealthy and the poor? And for me, it implies that it will be even easier to make a lot of money off of the wealthy and even harder to find capital that's willing to work at providing services to the poor.
Okay, so do you all understand the question? There's a little bit of echo, right, on the room. So the question was whether, that I seem to be talking about capital being a constraint and whether it's going to get worse going forward because you can make more money off the less poor. It's been really interesting. If you had asked me that question 20 years ago, I would have been one of the ones who said, the banks are coming, hold on, okay? I don't think it's true. And in my experience, I've worked a lot with banks. In my private practice, I've worked with some of the largest banks that are today doing microfinance. And I've also tried to sell the thing to a number of other banks. And I think it's not going to be the case. I actually don't think capital is a key constraint. The capital we need is lunch money for the bankers of any particular country you're in. Okay, it's just not that much money. I think the binding constraint is that the technology behind supplying financial services to the poor is still very human resource intensive. And so when you have bankers who have thousands of employees, and in many countries a really tough bank employees union, you know, when you have salary ranges that are among the highest ranges of any salaried person in your country, okay, to add another 1,000 or 2,000 or 5,000 employees to your operation is a non-starter. So I've talked to them about the profits to be made for a long time. And they just look at me and say, great, love it. And how many people do you want me to hire? And they're all going to be part of my employees union? You've got to be kidding. And they got to be at the salary scales that my employees union has already negotiated. Can't do it. Or they're going to be below, the union will never stand for it. I think the HR limitation for commercial banks may be more fundamental than a capital constriction. So when I see bankers turn me down year after year after year, it is almost always for those kinds of considerations and not a profit, not a business case in the sort of narrow financial sense. They're happy enough with the profits. We're good on profitability, slow on internal rate of return, right? Our internal rate of return is a little too far out for most bankers, but that's not the killer. The killer is, what? You want me to hire 5,000 employees? No. I'm not interested in that. That's because it goes in exactly the opposite direction of banking, right? Banking is using technology, algorithms to eliminate staff. And so what we're doing is going in exactly the opposite direction with traditional microfinance, right? Now, as credit bureaus get built up in countries and you start having a lot more information available, you know, the algorithms will move down market and they'll start to get applied to broader and broader segments and start to include our people. I live a long time in Chile. Chile's got a great credit bureau. Microfinance in Chile rests heavily on credit bureaus, but they're 20 years ahead of most countries in terms of having data availability. Great, thanks.
Thank you very much.